Thank you very much for inviting me back, distinguished ladies and gentlemen. Let me tell you a little bit about the theme for this, which is sort of an old horse I've been riding for the last 20 years, which is really we have to be careful, as you just heard, about uh, using monetary policy too hard and thereby having unintended consequences. And what I want to do today is just use some of the recent research and, in a sense, tie them together into making the case that we have to be careful about using monetary policy where it is needed, but in as conservative a way as possible, and not branching out too strongly, for that creates more problems potentially than it can solve. So let me start by talking about the separation principle, which is something a lot of central bankers believe in. That is, central bankers have relatively few tools. Some would say only one tool, which is interest rate policy. And so that can be used to perhaps drive monetary policy to create low and stable inflation and adequate growth. But to spread beyond that is probably a step too much for central bankers. And so if they want to address issues of financial stability, they should use other tools, such as macroprudential tools and so on. And this belief of separation, one side takes care of monetary policy and macroeconomic stability, the other side takes care of financial stability, is entrenched in some countries by having entirely different organizations dealing with the two. A separate monetary policy committee and a completely separate financial stability committee. Now, of course, many central bankers would acknowledge that there are links between the two. That is, a period of relatively low interest rates can prompt a search for yields, more risk-taking, which eventually can create problems further down the line. And it's not just interest rates, as central bankers have discovered new tools, such as a permanent increase in liquidity through an expansion in the central bank balance sheet. Maybe that could be something to enhance monetary policy effectiveness, especially when interest rates are stuck at the zero lower bound. But again, does that have unintended consequences? I would argue that the recent evidence suggests, yes, there are these connections, there are these unintended consequences, and the separation principle simply doesn't hold. In part because the kinds of tools that monetary policy has are much more significant, much more effective than the kinds of tools that macroprudential supervision, etc. have. So when you have the central banker pushing firmly on the accelerator with very, very low interest rates and QE and so on, it's very hard for the financial stability folk to sort of offset that with whatever tools they have. They're far weaker tools. And in that sense, we need to understand there is this link, and this link is exploited all the time by the private sector. And I'll come to some of that in a little bit, which also adds to the view that maybe central banks are part of an elite cabal working to further the interests of a few at the expense of the many. So we play into the hands of people who made that kind of commentary. Now, why should we worry about that? After all, central banks have powerful tools. Can't they fix any problem that they create? And the answer is, yeah, they can, until they can't. And the reason they can't is when the political establishment turns against them. We haven't seen that happening in developed countries so far, but I wouldn't put it beyond the realm of possibility that someday people will say, oh, your central bank liquidity intervention is just to bail out the big hedge funds, and we don't want that. and you find a far stronger economic reaction, because the liquidity that was plentifully available and thought of as available doesn't actually show up when it is really needed. So we have to be aware that the politics can also intervene, and it may not be possible for central banks to come in with all guns blazing all the time. So let me just put out some papers which make the link that I talked about between monetary policy and credit and outcomes. The paper by Jorda, Schuleric, and Taylor, appropriately entitled "When Credit Bites Back," examines a bunch of business cycles in 14 countries, focusing specifically on business cycles that coincide with the financial crisis. And they examine the effects of excess credit in both the extent of the downturn and the duration of the recovery. And what they mean by excess credit is higher credit to GDP, that ratio growing faster relative to the mean in typical expansions. And they find that financial crises, recessions are worse. We know that from seeing the global financial crisis. But they also find that the more credit expands, the worse you're off when actually the downturn comes. So this is the point about credit biting back. And this is, I have one graph per paper, so this is the graph I picked from their paper. What you have up there is the normal recession. And there, more credit doesn't make a big difference. Those fuzzy lines that you see around the top black line, that's if you have more credit, doesn't make much of a difference. At the bottom, you have financial recessions, which are worse because the y-axis is real GDP per capita, the extent of deviation from the norm there. And what you see is real GDP per capita falls much more in a financial recession. But the more credit growth there was in the prelude to the financial recession, the worse you are, right? So it's saying there's a connection between credit growth and financial recessions. The next paper I want to talk about, remember I have to do a bunch of papers in 20 minutes or so that I have to talk, so this is going to be really fast. One graph per paper and maybe 3 minutes per paper. No identification, nothing of that sort. Actually, I will bring up identification once. So in this paper by Grimm and a bunch of co-authors, some of whom are the same as the ones we just saw, what they look at is, I said financial crises are worse. Is there a connection between monetary policy and financial instability? And again, they look through a whole bunch of crises. And what they measure the stance of monetary policy by is by where the real rate is relative to a measure of where the real neutral rate should be. Now, for those of you in this room, I don't need to explain what the real neutral rate is. Broadly speaking, it is the rate which is appropriate to achieve economic equilibrium. And if you have a rate above that, you're being contractionary, you're contracting the economy. If you have a rate below that, you're expanding the economy, perhaps more than necessary. And so what they look at is how the stance of monetary policy affects the extent of the probability of a financial crisis. And what you see is that on average, and that's the left graph up here, look at the average line, the blue line, in the years before the onset of a financial crisis, monetary policy is too loose. The real rate is below where the real neutral rate should be. And that's true not just of the average recession, it's true also of the 2007 recession. This is a point that John Taylor has been making for a long time, that the rate in the preceding years before the global financial crisis was way below the Taylor rule rate that he would have espoused. Of course, there's a debate between Bernanke and Taylor about whether that's right. What you also see is credit to GDP growth is higher. So remember the previous one? More credit means worse outcomes. It's saying there's a connection between monetary policy and credit growth. The more accommodative monetary policy is before the recession, the financial crisis hits, the more credit growth there is, and that makes things worse. What they also show is that the more accommodative the stance, the higher the probability of a financial crisis down the line. What you have on the left graph is what happens if there's a 1 percentage point more accommodative stance than normal, and you see that there is a somewhat higher probability of a financial crisis 6 to 8 years down the line. The right graph is what if your monetary policy stance is within the lowest or the most accommodative lowest 20th percentile of monetary policy stances, and there the probability of a financial crisis goes up to 12, 14% before by 6 to 7 years from then. So that's paper number 2. Paper number 3 is, well, let me actually, this is partly the identification question that for those of you who are not familiar with the identification question, it's an inside joke in academia. What it means is, look, you showed me monetary policy, but monetary policy is endogenous. Can you show me a situation where I sort of have a shock to monetary policy from outside, completely unrelated to economic conditions? Does that produce different outcomes? That would be a true sense that it's monetary policy causing things. Well, what these guys do is they say, hey, there is a shock like that. What happened in Europe? In Europe, in the lead up to the financial crisis, you had different rates of inflation in the periphery countries, higher rates of inflation typically, lower rates of inflation in the core. So the stance of the European Central Bank was really more fitted to the core, to Germany, to France, and not to the periphery, that is to Spain, Ireland, etc. And what that meant was the periphery, that's the blue line, had a much more accommodative monetary policy because inflation was higher, real rates were lower than what was appropriate, while in the core, it was much more sort of a fairly neutral monetary policy stance because the ECB was setting policy for Germany, France, and so on. And so when you see that, everything that we talked about just now shows up. You see credit growing much faster in the periphery than in the core. You see household credit going up, mortgage credit going up, business credit going up, house prices going up until they crash post the financial crisis. So the periphery did pretty badly during the global financial crisis. The core did somewhat better. And that's consistent with what these guys are saying. Last paper I want to talk about in these lines is what we talked about was real interest rates earlier. There's a parallel paper, again, by a set of co-authors who have commonalities, Jimenez, etc. And what they show is just look at nominal interest rates because inflation is fuzzy. You don't need to look at real interest rates. If you just look at nominal interest rates, you see the same U shape before a financial crisis. A period of accommodation, when the imbalances build up, there's a lot more credit that is given, and then a period when you tighten just before the crisis and precipitate the crisis, right? So you've created the imbalances, then you say, hey, this is inflation is picking up, things are getting out of hand, let me fix it, and you raise interest rates, and lo and behold, you have the crisis at that point because credit sort of stalls, you have sudden stops, and everything implodes. So what they show is, depending on different authors have different definitions of what were crises, what were not, they show you the same pattern regardless of which ones you pick as a financial crisis, the U shape before the crisis, and then all hell breaks loose. They show it for a number of crises in the 20th century, but also you see the same pattern post-World War II. What they also show is that, take a specific country like Spain, and you can see this pattern. What you have in the dashed line, blue line on the left-hand side, is the ECB interest rates. These are nominal interest rates. What you have in black is the credit growth, loan growth. And you see that in the period as interest rates were brought down, loan growth picked up. And it picked up right up to the point that interest rates rose very high. When the interest rates rose very high with a lag, you saw the red line, that is the non-performing assets pick up. So the attempt to rein in credit growth essentially tipped the economy over the edge and caused the buildup of non-performing loans and in a big downturn in Spain. And finally, again, to deal with the issue of identification, I promised I wouldn't say very much, but again, what you see is, so the big question is, is this all because of what's happening within the economy? How can we tell what policies, what sort of problems monetary policy is dealing with? Well, these guys, Moraes et al., I should have had the Moraes up there in 2018, have this very interesting experiment where they basically look at foreign banks in Mexico, which are influenced by monetary policy in their home country. And they ask, are the banks in Mexico, which are, for example, European banks, are they influenced by the ECB's monetary policy? And do they follow the same pattern that we've seen earlier? When the ECB is more lax, do they increase credit growth relative to Mexican banks? So it's not about local conditions. It's about my monetary puppeteer sitting back there at home who is changing the monetary policy conditions for my parent bank and therefore changing the credit that I give. And they find exactly that. That is, American banks are influenced by the Fed. The ECB, the European banks are influenced by the ECB. The monetary policy stance of the foreign bank, of the place where the foreign bank is headquartered, affects credit volume in Mexico, lengthens loan maturities, and increases the probability of future loan delinquencies. So monetary policy does have effects, and it generally leads to greater risk-taking by the banks based on the monetary policy of their home authorities. Okay? So all this is saying there is something here. It is not just a function. It is not just a quirk of the data. Why does risk-taking increase when interest rates are really low? My colleague Jeroen Ma has written a behavioral paper on why this may be there, but there are lots of explanations for this. For example, if I have a kind of end-of-life savings goal, this is the amount of wealth I want. When rates are really low, I need to up my current income because I don't want to eat into that end-of-life sort of savings. And so risk-taking increases because I want greater nominal income at that point. There are accounting reasons. To enhance your bonus, you may want to increase risks. I mean, that's presumably what Silicon Valley Bank was doing. Why not invest in short-term treasuries? Why invest in long-term treasuries? Because we get an extra spread, which goes directly to our bonuses. Or sometimes genuinely to cover fixed liabilities or fixed costs. I gave a speech once at Jackson Hole where we had talked about the risk-taking sort of incentives for banks given fixed, but there are so many other ways of explaining it. My colleague Rohan Kekre and Lenel have a view that lower rates distribute wealth to the risk tolerant. That could also explain more risk-taking. Broader point, there are a whole bunch of reasons why, in fact, low for long tends to increase risk-taking. So, of course, this creates the problem for when conditions turn. And eventually, conditions often turn. Um, um, we do know that earlier, when business cycles were much shorter, they have lengthened over time. Conditions turned faster. And so the extent of expansion was more limited, the extent of credit growth was more limited, and as a result, things weren't so bad when they actually happened. One of the potential problems more recently is the credit cycle is much longer, and that it allows a lot more buildup before the eventual turn comes, and things may be worse off as a result. And I'll come back to this because it's a point the BIS has made repeatedly. What I want to talk about in the last few minutes is another tool, which seems, again, very benign. We're using the interest rate tool. We've maybe at the zero lower bound, we reach the limits of its effectiveness. Well, let's try another tool. Let's flood the market with liquidity. Let's expand the central bank's balance sheet. When you expand the central bank's balance sheet, what you're doing is putting out central bank reserves as a liability of the central bank. It becomes an asset for the financial sector. It's the most liquid asset on the planet, a central bank reserve. So you've got more liquid assets on bank balance sheets. And on the one hand, this is sometimes useful in repairing markets. When the markets are broken, they're looking for liquidity. You're pushing more liquidity into the system. You're taking away long-term bonds, maybe mortgage bonds, and you're replacing it with really liquid reserves. But also, it may be a monetary policy tool, and this is where we're still struggling to understand how it works. But the idea is maybe expanding the central bank balance sheet may have some positive effects in expanding activity when you're at the zero lower bound. So it's an additional tool, so to speak. Now, you might think, well, if that's true, shouldn't flooding the market with liquidity not reduce the possibility of liquidity shocks? The system backing up and suddenly saying, where's the liquidity? Liquidity drying up. It turns out that we've had a lot of episodes where liquidity has dried up, even with the central bank balance sheet having expanded so much. In September 2019, we had a backup in the US financial markets, just out of the blue. And it came at a time when the Fed was trying to shrink its balance sheet, but the system backed up when there were approximately $1.4 trillion of reserves out there, way above what they had been earlier. So somehow 1.4 trillion was not enough. In March 2020, even after the Fed came back to pushing more reserves into the system, it backed up again. That was more understandable, perhaps because of the pandemic. In March 2023, it backed up again. We had the Silicon Valley Bank crisis. By the way, many people dismiss the Silicon Valley Bank crisis as a small footnote in banking history. The amount of bank assets that failed in March 2023 was the largest in US history in a single month. Okay? So it was not small. There were 22 bank runs happening at the time Silicon Valley Bank failed. What did make it relatively small was the Treasury opened its book and basically said we're backing all the uninsured depositors, and the Fed came in with a bunch of facilities which expanded liquidity once again. It was the system being rescued which kept it to being a relatively small crisis. It was not that the underlying crisis was small. And I'll come back to that in just a second. So why do we have these unintended sort of events? And even in the last couple of weeks, in April, we had the view that somehow perhaps liquidity was at a premium in markets. We had some markets, not the bond basis swap, but some swap markets sort of drying up. So why is this the case when you've expanded the central bank balance sheet? And once again, I would say it's because of unintended consequences. And let me be very quick in the interest of time. What I show here is based on work with Viral Acharya and others, is the blue line is the central bank reserves that are put out in the system by the Federal Reserve. And what you see in the first 3 phases up till 2014 are the 3 phases of QE, QE1, QE2, QE3. Then you see central bank reserves coming down partly in a benign period when it was neither QE nor QT, and then starting in 2017, the Federal Reserve started shrinking its balance sheet actively. That led to what they call quantitative tightening, and that ended in September 2019 when the system backed up. Again, the Fed started pushing reserves into the system, and of course, when the pandemic happened, it expanded its balance sheet hugely. Okay, so this is the system, in a sense, being liquefied by the Fed. Why does this not have more of an effect in making the system liquid? Is because the private sector understands it. And as the system is being made more liquefied by the Fed, the private sector issues more liabilities on liquidity, which require, in a sense, those assets that the Fed is putting out. Put differently, the private sector is eating up liquidity at as fast a pace or even faster a pace than the Fed is producing that liquidity. At the end of it, there isn't that much spare liquidity left. So when the Fed starts tightening again, it starts backing up at a much higher level of liquidity than in the past because the private sector has used it up. How does the private sector use it up? Let me show you 2 aspects of how it uses it up. One, the private sector issues more deposits. I'll show you in the next screen, it's not just ordinary deposits, it's uninsured demandable deposits. The most rapid sort of liability, the one where people can pull at a moment's notice. That's what happened with Silicon Valley Bank. Why did Silicon Valley Bank have 97% of its deposits uninsured and demandable? Why did it suffer a bank run? Why did 22 other banks suffer a bank run? Because they'd issued an increasing number of uninsured demand deposits, even as the Fed put out more and more liquidity in the system. The other way they actually sell liquidity into the system is by offering firms credit lines. You want liquidity? Come to me. I will help you get the money. And so credit lines are, again, a demandable form of liquidity, essentially promises issued by the private sector to corporate firms and others. So as the Fed puts in liquidity, it flows out by the private sector making promises of the liquidity. The system becomes more liquidity dependent. I told you I'd show you demandable deposits. Let me, in this complicated graph, the gray line is just reserves, what we already saw, but the black line is demandable deposits. And you see demandable deposits going up, even uninsured demand deposits is the black line, that's going up even as the Fed puts in more reserves into the system. There's no spare liquidity in the system. Unintended consequence? Yes. Should the Fed have been more aware that this was happening? Yes. And it realized that this was happening only when it saw the system back up and understand that all the promises had been made. So why does the private sector do it? Simply because sitting on unused liquidity is very costly. If I have to hold a reserve, I'm not earning a lot on it. So why not issue claims against the reserves? Because the private sector is willing to pay. Somebody I offer a line of credit to is going to pay me a premium for that line of credit because it's a promise to give them liquidity when they want it. And as a result, I'm making money from it. I'm selling my liquidity. And so the private sector will sell this liquidity to all those who need it. It'll also finance in the cheapest way, which is issuing uninsured demand deposits, because uninsured demand depositors know they can get their money when they want, and as a result, are willing to accept low interest rates for that. So what's the bottom line of all this? Low rates and high liquidity induce the financial sector to take risks. Unintended, of course, consequence is that the system can blow up. Of course, what this means is that when the system blows up, the Fed has to intervene again. By the Fed, I'm putting a stand-in for all central banks. They have to intervene again. And Greenspan actually made this a doctrine that we can't prevent the blow up, but when the blow up comes, we'll come and help the system. This is a famous Fed put. And it's today not just on interest rates, but also on liquidity. When the system needs liquidity, we'll come and provide whatever it needs. But of course, this kind of intervention increases moral hazard. And the private sector takes full advantage of it. There's so many cases in history of this. But I would say a simple example of the unintended consequences of monetary policy is what is today known as the bond basis trade. For those of you who don't know what it is, it's essentially a whole bunch of insurance companies and pension funds want higher returns on their long-term assets because they've got long-term liabilities. But they're not satisfied holding long-term treasury bonds because they don't pay enough. They want higher yield. So what they do is they buy short-term corporate bonds to get the higher yield. They take on some credit risk, but they get a higher yield. And then they try and lengthen the maturity of that, in a sense, hedge their duration risk by essentially trying to buy insurance from hedge funds. And hedge funds provide them that insurance, but in the process are themselves dependent on continuous rolling over borrowing from banks. So what this does is create, both on the one hand, more risk-taking, and on the other hand, creates a liquidity dependence. Because if the system becomes illiquid, those hedge funds can no longer roll over their borrowing. They have to dump their assets in the market, typically long-term treasuries. That creates a big spike in long-term rates. The Fed then thinks the system is broken. It comes in, floods the market with liquidity, bails out the hedge funds, and of course, in the process, effectively bails out the pension funds and so on. But the system has become really dependent on the Fed to be the savior of now increasingly first resort rather than last resort. Is this the kind of system that we want? I'm going to stop by saying the kind of intervention the Fed does will always help the system in the short run. It makes the system, makes the crisis less severe, ensures asset prices come back, ensures deflation is avoided, all good things. But in this study, and this is the last study I'm going to talk about by Ferguson et al., they look at a bunch of these interventions and essentially find, yes, it does work in the short run, but it creates a higher probability of a crisis in the next 20 years. So short run good, long run bad. So I'm going to end by saying, okay, what's the problem? Why worry? Let me stop with this. This is the last slide. Why worry? And I would say, why worry is the political economy eventually can back up. Okay? The temptation to make profits in this kind of environment is very strong. And so the political economy of regulation goes towards more deregulation, leave us alone, don't interfere with the bond basis trade. That's great to supply demand for treasuries. Don't interfere with cryptos. That's great because we are creating a payment system, etc. So the political economy of regulation is primarily about deregulation. But at the same time, the political economy of intervention is, oh, we've taken all this risk. Yeah, you can talk about moral hazard, but you're going to kill the system. So you have to come in and bail out the system. So it's this yin and yang. You're going to increase the risk-taking, and you're going to increase the intervention. Well, why worry? Aren't you increasing activity? Well, this kind of equilibrium is okay until it blows up. What are the circumstances in which it might blow up? Well, One day when the political masters tell the Fed no more intervention, for some reason, why is that impossible? That somebody says you cannot bail out the system anymore. And in that case, what you have is a system which is too dependent on the potential bailout which doesn't come. And then the kind of implosion that you can have can be much more severe. So somebody will test the system at some point. We're reliant on the system never being tested, never being stopped in its continuous sort of greater and greater intervention. Let me stop by saying, in the Silicon Valley Bank intervention, they rolled out a bunch of measures they'd taken in 2008 and 2009, plus some more. Nobody commented on that. The interventions are getting bigger and bigger. They are effective in the short run, but the system is becoming more and more dependent on the intervention. And in the long run, it is dependent on the political economy which supports continuing intervention. Otherwise, the system collapses. That's something we need to worry about. Let me stop here. I have some talk about macroprudential, and those are details you don't need to worry about. Maybe you can ask them questions. Let me stop there. Thank you.
Thank you, Raghu. That was a super insightful and thought-provoking speech. And I'm going to start with an observation, an historical note about this conference. The opening speech at the very first Asian Monetary Policy Forum, delivered by then Managing Director of the MAS, Ravi Menon, was also on the tension between monetary policy and financial stability. And I think his characterization of the tension was maybe a little bit more tentative than yours, but we've accumulated a good deal of evidence in the ensuing 11 years, much of which you very nicely summarized. So this is an enduring theme and really a central problem facing central banks. The latter part of your remarks I'd summarize by saying the appetite increases with the eating. And by that I mean that the appetite for liquidity in the private sector increases with the provision of central bank liquidity previously. And I wanted to ask you there the first question. You alluded to the political economy problem that makes it really difficult to solve this problem even when recognized. And I guess the way I would put it is slightly differently than you did, but no central banker wants to be the one who says, no, you know what, we're not going to provide the extra liquidity this time. We're going to let the Silicon Valley Bank failures run through the system. And no prime minister, no president wants that to happen under their watch. So there really is a very severe political economy dynamic there. And it wasn't clear to me. You said, well, at some point this might stop because for some political configuration. But another reason it might stop is simply we get to the point where a central bank and the fiscal authority that backs it no longer has credibility. And so they're not trusted. Their liquidity provision isn't trusted. And that seems far-fetched for the United States, maybe a little less far-fetched than it did 5 years ago. But there have been episodes where the fiscal authorities lost all credibility and hence undermined any capacity of the central bank, at least in the near term, to provide the kind of liquidity support that you talked to. So what can we learn from those episodes, and is it applicable to modern leading central banks?
Well, I think it is very applicable because it used to happen all the time with the emerging market central banks that you don't have the fiscal backing, and then people think that, oh, this kind of intervention is going to be beyond your real capability. Yes, you can have a nominal capability, but then nobody trusts your money, and then you have the mother of all inflation. So then you have a real financial crisis which you can't do anything about. As you said, it's sort of far-fetched for the U.S. so far. So we have to find another reason for the U.S. Maybe that reason sort of holds up for the U.S. But I also do think that there is a certain amount of obfuscation in what is being done in some of these actions. For example, the Fed in intervening is always about market repair. It's stabilizing market conditions. Of course, we can't let them be destabilized. But in the process, a whole bunch of hedge funds are getting, who were seeing their profits, their balance sheets being totally eroded, are seeing them rescued. We can debate for a long time about whether they're providing a necessary service. I think they're providing a necessary service conditional on your saying that pension funds and insurance companies should be allowed to take more risk, which is the basis of this bond basis trade, for example. But leave that aside. The point is, hedge funds aren't your favorite entity to be rescued for a populist government. What happens when the Steve Bannons in that government basically say, what the hell are you doing? And there's a sudden stop there. Then you have a pretty bad outcome, because there's so much dependence in the system on that liquidity.
Yeah, I take that point. And I guess I would add to it as follows. It's not just that we eventually might reach some outcome where the political system says, no, you're not going to do the bailout this time. But, with your remark about Steve Bannon, and I think this is true more generally, there's evidence that in the wake of major financial crises, like the GFC, but this goes back to earlier decades, there does tend to be a rise in populism.
Yes.
So all of the other costs that we might associate with populism of the left-wing variety or the right-wing variety are also in some sense costs of the failure to solve this problem that you're describing. So it doesn't have to eventually blow up.
Right.
As a major financial crisis. There are these slower working costs,
right,
that I think are also quite worrisome and significant.
Right. Any kind of rescue, even partial, raises the question, why did these guys need to be rescued? And is the system looking after its own?
Right.
That was the kind of problem we had post-global financial crisis. It's not a problem that's going to go away.
Right.
And I like to say this, the idea that institutions have an independence of their own, I think is wrong. Institutions need political support. And it's when the two work together that you really have the kind of rule of law, etc., that we love and cherish. When the politics go against the institutions, as we're seeing now in many Western countries, you're no different from an emerging market, because the institutions are steadily weakened by the lack of political support. No central bank is truly independent. It does depend on the politics supporting it. And if the politics, if the central bank chair is called a fool by the leadership, eventually it does weaken the foundations of the institution.
Yeah, I'm quite sympathetic to that, and I think it's a veiled reference to my home country. But I'm going to turn away from that and ask you about a different part of your remarks, and then I'm going to open it up to the floor, so get your questions ready. I was struck by your evidence, first in the common currency area, the euro area, and also Mexico. And there's some lessons I drew from that I want to articulate in a slightly different way than you did, and that's going to lead to the question. So you stressed the contrast between a monetary policy that might have been appropriate for the core countries in the euro area at the time. Let's just stipulate that it was reasonably appropriate just for the sake of argument, but clearly wasn't appropriate for the periphery countries in the way that it fostered an excessive expansion of credit that then blew up in a very bad way during the crisis with many negative consequences. And so that's kind of observation one, and what it suggests if you do find yourself in a common currency area and you're on the periphery, then monetary policy isn't going to be enough to solve your problem. So that's kind of observation one that's going to lead me to think about asking about macroprudential policies. But even the Mexican case that you mentioned, it's interesting that Credit expansion in Mexico was very much affected by monetary policy decisions in the ECB. There was a commissioned paper by Maury Obstfeld some years ago in this forum that made another version of the point, which I'll summarize this way, that financial shocks, including monetary policy shocks, but not just financial shocks, that emanate from abroad are not fully insulated in terms of their impact on the financial system, interest rates, credit expansion in open economies, whether it's South Korea or Singapore or Malaysia or other small open economies around the world. And I think the lesson that I took from that is either they can't fully insulate themselves from these costs, from these shocks, these external shocks, or it's too costly for them to do so in terms of what it would mean for their exchange rate movements and so on. So both of these types of evidence lead me to the conclusion that monetary policy is not enough, at least not in open economies, because they're so buffeted by these shocks over which they have very little direct control. So there needs to be some role, it would seem, for macroprudential policies. But you, and correct me if I'm wrong, you sounded a bit skeptical as to how much force these have.
I'm not. I'm saying we should use them as much as we can. I'm just saying they're going to be less effective than we desire. They can't completely counteract the effect of monetary policy. And therefore, we should be willing to use monetary policy also when we see the risks building up. And that's the small point I want to make. Let me leave it there. I mean, there's an additional point, which is the procyclicality of regulation. Post-financial crisis, we were really happy to regulate a lot. And then over time, we forget why we regulated, what we regulated for, and there is an incentive to cut back on the regulation. Oh, this is not necessary. We haven't seen a crisis in so many years. Oh, these guys were fine in the last problem. And we deregulate. And, deregulation happens when, in fact, regulation might be useful at that point. So there is a procyclicality in regulation, which is also something to worry about, which is why I don't fully trust it. But I'm saying, by all means, use as much of it as we can.
So one last follow-up on this, and you made the point that by many metrics, and certainly by a Taylor rule metric, U.S. monetary policy was too loose in the run-up to the global financial crisis. But I want to get you on the record as to whether just adhering to the Taylor rule would be enough. It sounds like, but correct me if I'm wrong, you're sympathetic to the notion that we ought to be in the business of trying to develop augmented versions of the Taylor rule, not necessarily as a mechanical way to conduct monetary policy, but just as in the same way that the Taylor rule serves as a guidepost for monetary policy, that we ought to be developing quantitative indicators of excessive credit expansion so that we have something both economically and politically to rest on in trying to head these crises off before they get too bad.
I think that's absolutely right. And here I want to just pay homage to Claudio Borio, who's been talking about this for a really long time. And Claudio's point was, the longer the sort of expansion lasts, the more the imbalances build up. So you want to measure it also by the duration to over which you've had easy policy, because then the credit expansion builds up. And his point was, earlier we used to have high inflation, so you'd slam the system with higher interest rates. That kept the imbalances from growing too much. With this more moderation in inflation, the imbalances have a longer time to grow. And I think he's very right. And I think the BIS has done a lot to make this point without so much traction amongst the central banks. We all listen to the BIS, but we don't actually implement any of it.
Okay, good. So let me turn to the audience now. I'm sure there are many questions and comments, and I see one back here. Is it Albert Kyle?
I'm David Hirschleif.
I'm sorry. My
as
eyesight's not very good.
Trying to be as admirable as Pete Kyle, but not there yet. Okay, this question will be purely about identification. No, just kidding. So I want to try to take your argument to what I see as the limit, which is we have central banks that were established in an era very, very different from our own. And when macroeconomic understanding was different, technology was different. Now we see this dependence on central bank activity that central bank activity can have adverse effects as well as beneficial ones. So is there any clear evidence that says that having central banks at all is a good thing rather than a bad thing?
You know, that's a deep, deep question. I think, look, I think the attempts to replace it by crypto aficionados hasn't really worked out, right? I think the growing sort of favor that stablecoins enjoy in recent times would suggest that, you know, the ability to convert to a fiat currency or to have value preserved in a fiat currency is still very valuable, even for the crypto world. That said, so all the usual reasons why we like credible central banks to protect the value of money, I think still hold, no matter what the crypto folks say. But I think the point you make is, when you think about the Fed, the reason the Fed was set up was not to preserve the value of the currency, but to solve financial crises. You know, if you remember, it was J.P. Morgan walking down the street during the Knickerbocker Trust crisis, and doling out favors, who he'd bail out and who he wouldn't, which led the U.S. to say, we can't be dependent on a private banker. We need to have a public bank which supplies liquidity at these times. So the Fed was set up to deal with financial crises as a bailer out of last resort. And then it moved to preserving the value of the currency. Now, I think the question we have to ask is, have the two become so enmeshed? And should we worry about that?
Okay, so I see many MAS staff members who are quite relieved that you think there's still a role for central banks. So let me go to Pierre-Olivier Grandchaz, and can we get a microphone up here?
Thank you, Pierre-Olivier Grandchaz from the IMF. Two questions that are somehow related. I think you started with the discussion of the separation principle, and I very much agree with a lot of what you said, but I want to bring in a distinction, which is, do we think differently about the separation principle in periods during which interest rates are low, or we want to push them down, versus when interest rates need to be raised? And the examples you provided were mostly of the buildup of financial vulnerabilities that arises when interest rates are low. But if I think about SVB, for instance, and the failure of regional banks in the US, this was not a period of low interest rate, this was a period of high interest rates. And the high interest rates also created vulnerabilities in the financial system, in part because of maybe mismanaged interest rate risk. So the question is, do you see them equally? There are financial risks when you lower interest rates, maybe not immediate. You are leading to a buildup of financial vulnerabilities that's going to blow up down the line. But is there equally an increase in financial risk that comes when you tighten policy rates because maybe inflation is high? Or how should we think about that? Is there an asymmetry there? So if I can squeeze in another question, I want to push you a little bit also on your answer to Steve on macroprudential. If I think about a small open economy, an emerging market economy, suppose that I see there is quite a bit of credit growth. I can't handle it with my macroprudential instruments. I follow your advice. I want to increase the policy rate. Now I offer a very nice carry to foreign investors. They're going to flood in, and I may not be able to control my credit growth. Do I use capital controls?
Great questions. To the first one, I think it's part of the same story, right? Which is why I showed you the U shape. period of easy policy leads to the kind of imbalances which then are vulnerable to the tightening of policy. Think of Silicon Valley Bank. Interest rates really low. It's not getting much from investing its deposits in treasuries. There is a term spread it can benefit from. Forget the hedging. That's for other people to worry about. We make that spread until suddenly interest rates go up. The Fed was not supposed to raise interest rates according to Silicon Valley Bank, but it did. And then everything blows up. So I think the imbalances build up in the period of low rates only to get sort of uncovered in as rates. Now, could the Fed have a more measured policy of raising rates? Perhaps. But of course, inflation didn't allow it at that point, and it had to catch up for that reason. On the open economy, pick your poison, right? on that one. I do think, yes, you do want to use, you could allow capital flows, but, have, tighter constraints on credit growth and so on. That would be a kind of macroprudential, more upfront provisioning for credit and so on, so that could be a way you deal with the inflows, that the inflows go into other assets and don't encourage credit growth. It's the combination of asset prices and credit growth, as you know, from Borio and Lowe's work and so on, that creates real problems. But I hear you, it is a problem, and it may well be that at some point you want to say, hey, capital, I don't really want you. You're creating a big problem. But you guys have written much more about it in recent years, so I leave you that terrain.
He wants to know if he got it right. I saw a big sign up there that said 1, but I don't know whether that's 1 more minute or 1 more question. So is it 1 more minute? 1 more minute, okay. And that was like a minute ago. So we're gonna wrap it up. I wanna thank Raghu for an excellent presentation, stimulating conversation. We can continue this. And I just want to note that, despite his many contributions, I know there's lots more good stuff to come in future years for Raghu for many years, because he's even younger than me.